Hey guys, it's Will here. I like to do analysis of the stock market indices, and various stocks. I've done NAT, which is a shipping stock, a bunch of times. And I thought I would talk about NKLA, which is a electric or hydrogen truck, company. Similar, in a sense like Tesla. I don't want to get into all the specifics because when I talk about trading, generally not looking at fundamentals. So, we're not looking at the profits and earnings and if they actually have products and stuff like that. We're just looking at the price action. And I look at candlesticks and various indicators and charts. I'm using TC2000 if you want to get a free trial or a $25 discount. You can check out the link in the description below. And there's also a couple of courses in a chat room for trading with candlesticks and learning how to trade using moving averages and indicators so that you can get a full in-depth analysis, because you need to understand trade management, risks, stop losses and all that stuff. So there's more to it than just, looking at the price. But so with this stock, there was a run up here because of, sympathy, I guess you could say, for electric cars and that type of thing. So you had this huge spike and then it came crashing down. So similar to NAT, when you see this huge spike and you've got this, one day insane, well, not insane, but a 17-18%, you got to be careful that it's going to come back down. And so that's where you look at stop losses. When you have this big kind of doji where the price was up here and it got driven right back down. As soon as you see a gap down like this, if you're not out earlier, here you can switch to a 10-minute chart and you can basically get out when it, I don't want to get into too many of the details, but you zoom in here when you see it spiking and it's gapping up like this, you go to a shorter term and then you get out at a certain point before it comes all the way back down here. And you looking at some moving averages. But if you're looking at the daily chart, obviously I use a lot of times this 8 EMA and I look at the trends if it's up or down. So you can see here that this starts to go down the trend in terms of if you drew a line like this. And then a lot of times, even if you break that trend to go upward a bit, it's pretty flat. So like using this 8 EMA, you can see how it's quite a bit below that line for quite a while. Then we had another run. So what you would do, what you could do is when you see this flat period and you're down below the 8 EMA, you wouldn't be buying there at all. So what you could do is draw like a trend line, like a horizontal line sort of thing like this. I usually put it at the top. It's kind of like the resistance level. And then you start to see when it breaks through that. So that's an opportunity, say right here. So TC2000 has these drawing tools. It's really nice. So I'll put like arrows like this. I'll leave them on the chart. And these are kind of like spots that you would want to enter in. So what would happen is you would put TC2000 has this alert system. So like say you have your line here and it might have broken, it actually would have broken the day before, but then it came back down. So you could have bought there as well. But if you right click on that trend line and you say set alert, it'll put an alert at that price, or it'll put an alert, it'll let you know when it crosses that line. So you don't have to sit there and watch. So once that day when you saw, after 15 minutes or so, it going, you could have potentially gotten in. And then your rules would be, when you see, what I use, there's different ways to go, but you could look at when the stock closes, when the candle closes below the 8 EMA. So you could have got out here and then you would have probably gotten back in. So it's not always a perfect system, but you don't, if it was close like this, you may not, but of course you see the wick down here. So it came actually all the way down. So what you're looking for usually is the close at the end of the day. And so because it was pretty close, you could have decided to wait. The other thing you can do, if you want, if you have, it depends when you bought in, if you still have, some profit. And one of the things is look at this this is a 3 EMA. So it's an exponential moving average. And you can see how even though it closed down just below the T line, the 8 EMA, your 3 EMA is still above, so you could have stayed in. And so even if you sometimes you have to buy back in right away, but at least it prevents this from crashing and burning. So it's not going to be 100%. It's like a probabilities situation. So when you saw it going up like this, the next thing would be, if you did buy in, would be when you get out, and you'd probably sell here when it grows below the T line. There are ways to get out before. When you see there's certain candle signals like a dark cloud. Now this would have to come down halfway below, which I don't think it's not quite halfway. So it didn't quite come down halfway of this previous candle. But if you're gonna wait for the close below the 80 EMA, then you would have gotten out here. And a lot of times you'll see a flat period for a while. And then once you see like a gap up and then above the T line again, the 80 EMA, you'd probably get in there. So that's another spot. So you could put a line across like a flat from day to day when you start seeing it. And you could be like, I'm not gonna get in until I see it cross up here. And that's another alert. And then when you see a gap up like that, that means that overnight, like in the pre-market, it went up. And then, so that would be a pretty good indicator of a chance to buy as well. And then you would ride. Now you're seeing this thing go exponential right here. So this is where you get, as you start seeing these huge gaps and huge gains in one day, 25% or more, is when you want to be careful and have stops, at a fairly close level. You could potentially, instead of having them, at a daily level, when you're starting to see this, you could shift to a shorter term duration and have closer stops. Or you could take half your profits. And then when we see this is like a spinning top, this big, huge wicks, and then you see it gap down. So if you didn't get out here and go to a short, like I said, when you start seeing a parabolic, you switch to a shorter term, and you can get out at it when it crosses below the 80 EMA on that particular shorter time frame. But if you didn't do that, when you see it gap down, and you're way up in this oversold, so I don't know if you know about stochastics, but you're up in this high, in an overbought, condition. And so when you see it gap down like that, you probably want to get out at that point. But if you're following strict rules, and it would come all the way back down. So when you see a gap, it's probably going to come back down and test this 80 EMA. So you might have wanted to sell. It was very close to the 80 EMA, so you could have held it there. So let's just keep going a bit further. This is a nice feature with TC2000. I use the brackets, left and right brackets, to go one day at a time. So if you go back in time, you could actually pretend that you're not aware, you don't remember, you go back to a previous point, and you could look and see what you would do. So it's like a paper trading sort of idea where you can step through this and see, what you would do without knowing what the future is for that. You don't want to be doing it fairly recently. You want to go back in time and not really know what was going to happen. So just to kind of see what you would do. But another indicator that's on this chart is a volatility stop, which is, it's a point that represents, it takes into account the average true range, which is basically when it goes to red, it's usually a sign that you want to be shorting, or not buying, let's put it that way, not holding, because it's above the stock price. And I have my own criteria for when I would buy, but the green are definitely, you can notice a lot of times the green dots are usually a good indicator that it's, it's a good time. It's not 100% obviously, but these are pretty good. So when you see the red dot, that's, not always, but potentially a time that you don't want to be holding at that point. Because generally you'll have a bunch of green dots and then a bunch of red dots. It doesn't always work that way, but so anyways, I'm going to get to the point where, we actually, the current time, but I was just gonna kind of scroll through this. Sometimes you get a little bit of a bump and then it comes back down. So, if you bought in somewhere here, you don't necessarily, you're still getting a decent 20% just from here to here, but you don't know as it's going up where it's gonna, bounce back down. So This was a gap here, so sometimes people will draw a horizontal line. You could put it at the top of the gap of the candle, the low of the candle, or the close of the candle, and you can see how it got into the gap, but then it didn't make it through. So that is a potential resistance point. But if you got in down here, you might know that and try to get out if you start seeing it coming down. So it kind of gapped up here, and then the price started going down. So you might have potentially gotten out just with that short period right there. But the other thing that's nice to see when it comes back down is that you're getting support at a trend, or you can also draw a line like this at a trend line. So you have also the 8 EMA where it kind of stayed, so that's a good sign. And same with here. So a lot of times I know people that buy right at when the price is close to the 8 EMA, which is where the 3 EMA is close to the 8 EMA. So you can see how close these two are. And that would be a sign of potentially a purchase point. So you can buy, and then when it gets away from the up high off the T line, you could sell. And then once it gets back down to the T line, you could buy again and way up here and sell. So you can do that as a strategy. But I'm just going to scroll, and you can see the same thing happened multiple times. When you get these big, huge candles and you're up at this overbought area, and you have a gap up, is where you want to watch, and you started seeing the price coming down, so you might have wanted to get out right there, or you can wait and see what happens. See, because you see this huge drop, and then it supports at the 8, but you don't know it's going to support here. It could keep going back down. So that's where you switch to your shorter durations, and you could get out more fine-tuning kind of approach. So I'm going to keep scrolling. If I purchased like here, or I was holding, I would keep it, generally speaking, because I'm still above the 8 EMA, but you can see how it's pretty flat. So there we would probably sell because we dropped below the 8 EMA if you didn't get out sooner, because this is kind of flat. So, but you could be holding this and see what happens. So the beauty of what I'm talking about is this 8 EMA is if you got out here, if you're even in the stock, it might turn around and come back up like I've talked about earlier, but then you see this big drop here. So you'd miss all that because you get out right at that point. So sometimes you do get a rebound right away. And so you buy back in and there's not a big loss there. You might buy it at a bit higher price a little bit, but it's not like, it's just going to prevent you from having these big losses. So then we see that it actually, it's amazing, but it's supported at the 50 and bounced back. And that happens a lot of times. But you don't necessarily, like for longer, like day or swing trading, you don't really want to get in just because it bounced and supported at the 50, and then you have this gap here because you're still below the 8 EMA. And then when this price closed, you're not looking at the fact that the open was up here, you're looking at the close, and it's pretty much right on the 8 EMA. I wouldn't buy, because you wouldn't be buying, and you'd watch and see what happens. And the other thing is the 3 EMA is still below the 8, and you want it to go above, you want it to flip over. So the other thing that happens is that you have downtrends. So when you have, depending on how you draw this thing, you want to give it a chance to establish like an uptrend before you just jump back in. That's my approach. It's a little more conservative. Some people, as soon as they see like a reverse, they get in, but it kind of burns you a bunch of times. So I don't really recommend that. So you can see, I'm just going to scroll to the very end, which is today, the 24th. So I wouldn't have bought all this because the 3 EMA is entirely below the 8 EMA, and the candle never really closed above the 8 EMA. So once you got out here, if you were in there at this point, this wouldn't have gotten me in. So sometimes you'll see it drop, come back up, and you're thinking, oh, it's coming back, and then it bounces off the 8 and goes back down again. So that would be almost a shorting opportunity, to get in because it's not breaking through. So the short answer to this long video is that it's not a buy, obviously. in my opinion. Some people are looking at like, oh, the price is low compared to where it was, so I should buy, and this is an unbelievable company, and etc. I don't really like follow that approach. I'm just looking at the technical. So we had this big, huge uptrend and things were moving, and then usually the novelty wears off, and then there's this big dump. So I definitely don't think right now this is the time to get in. And since I mentioned NAT, I might as well just talk about it because it's kind of similar in a way. Is we had this big, huge spike and then this down, and then you get a little bit psyched out here. It could have been a chance to get a little bit of money here, but nothing. And then you're down below the 80 MA here, and it did cross up above, but the 50 is right there. So when you're going to buy a stock that comes back up above the 80 MA, you have to look at the 50 and the 200 moving averages. And if they're pretty close, I wouldn't probably bother, because it's going to generally bounce off that until it breaks through. So you see how it came up, hit the 50 and came back down. I know, like, if you don't know too much about technical analysis, it's kind of hard to understand, but a lot of people are looking at the 50 EMA or 50-day moving average. So like I said, you could have bought here right when it entered, knowing that you're probably going to get out there. So you would have had a good 8%, but it's not a big spot. So you want to, and here's the 200. So you can see how it bounced out the 200 and supported, and it also supported at the 200 here. So we're in this kind of a flat consolidation period, and I definitely, I wouldn't be getting in right now, and I'd be watching this for an uptrend, but probably want to wait to see that it breaks up above the 50. And like I said, you can do a few things. You can put, if you look here, say you wanted to make sure it crossed the 8 or the 50, you go up here. I've got these moving averages, and you can say set an alert, and when the price is instead of greater than, you say crossing up over the 8. And then if you wanted to do that for the 50, you just go over here, and then you'd say crossing up over the 50. So, and then you don't have to be sitting there waiting. But or like you might forget and not go back. So having a bit of a system like with alerts and things can really help you sort of stop just checking stocks all the time and looking at them and seeing if anything's changed, and then you end up missing some of the moves. So that is the long and short of it. So I would say not to get into NKLA at this time, but maybe I'll do another video in the future and if things change. Talk to you guys later.